Okay, thank you all very much for joining us this evening. I'd like to welcome you to another special Founders Council session. And as you may know, our Founders Council sessions are in the evening, and normally in the morning we talk about things where we can make money. But in the evening, we talk about things that are concerning process and ethics. So, our topic tonight, best practices managing complexity, is an examination of liquidity, leverage, volatility, and how they all behave when combined. Tonight is a formal release of our white paper that we've been working on for the past 15 months. And tonight we'll listen to four of the most respected people I know. And I'll briefly introduce them after I say this. Their views are their own and don't necessarily reflect the views of the Roundtable trustees or their members. So, having said that, Vern Sedlacek is an old friend of the Roundtable and our mentor. Mr. Sedlacek is the Chief Executive Officer of the Common Fund, a not-for-profit asset management firm specially created by Congress and seeded by the Ford Foundation and serves over 600 endowments. Vern joined the Common Fund in 2002 and quickly started turning this legendary firm around. Before the Common Fund, we met Vern when he was president of John Henry and Company. And Vern was sitting on the dais here in 1998, and it was Vern who coined the phrase, "There are many painters but few Picassos." I don't know if you remember that, Vern. But
no, I don't remember that.
I'm
glad whoever I stole it from doesn't remember it either.
By the way, this session is being taped. So,
now you tell me.
Now we know. And so was that one, and that's how we know. So, anyways, before that, he served as the Executive Vice President and Chief Financial Officer for the Harvard Management Company, and Vern's been instrumental in formulating governance for not-for-profits all over the country. And most importantly, he's head of the Common Fund Institute and the Endowment Institute, and he has served as our role model in educating limited partners. Sitting next to Vern, Gordon Yeager is the head of risk management and operations at Solus Capital. And Solus is a $3 billion general partnership that focuses on distressed and high-yield investing. But more importantly, Gordon's been working to raise the bar in the industry. He's been a thought leader in risk management, and he's worked methodically across a wide range of disciplines, including trading desks, prime brokers, and most recently at Risk Metrics, where he headed their alternatives business. Gordon headed the Education Committee's working group on leverage, so please welcome Gordon tonight. And sitting next to Gordon, to say that John McFarland is an old friend of the Roundtable would be an understatement. John is the chairman of the newly formed Zafferano Capital. Zafferano operates as a special situations partnership, shall I say? Partnership. It's
strategies. We've not yet launched, but it will be. We'll have two strategies, two LPs. One which will focus on special situations, and one on more liquid, called an opportunity strategy.
Thank you, John. I couldn't find that in the internet before you got here, and you were stuck in traffic. So, but thank you. But Zaffer and with a collaboration with Paul Tudor Jones and Partners. But most of us know John for two of his legendary roles. First as Chief Operating Officer at the Tudor Group, guiding that firm through its biggest years, but also for his role as Treasurer of Salomon Brothers, where he worked with Warren Buffett to save that firm during the Treasury bidding crisis. John's also been a key figure in building the ethical infrastructure for the industry. For the record, it was John who first suggested in 2003 that the Greenwich Roundtable begin publishing best practices for limited partners. So 8 years and 6 white papers later, he's finally here. Thank you, John. And finally, Rusty Olson is a special moderator of the Greenwich Roundtable tonight. I should say the Founders Council tonight. Not only will he be working the shot clock, but he's going to weigh in with a bit of wisdom whenever he feels like it. And Rusty's the editor of Best Practices, this white paper that you now are in possession of, and the legendary former director of investments at the Kodak Pension Fund. So please welcome Rusty as he hits the buzzer for the session to begin. Rusty?
Okay. Evening,
I'm happy to
Kick
start.
it off, Vern.
Okay, great. Thanks, Stephen. Thank you for publishing this white paper. I had a chance to read it, and it's absolutely spectacular. It deals with kind of three fundamental issues associated with complexity: volatility, liquidity, and leverage. And it's really interesting. I've been doing this for roughly 30 years now in the investment business, investing, endowment funds. And when we think about the complexities of what we call today alternatives, it's really interesting to think about why would anybody invest in alternatives when you think about all of the issues that you have. And so you kind of start with the issue of less liquid, complex, leverage, skill-based, manager skill-based, higher fees. So you go down all these lists of 6 or 7 things and you say, these complexities are built into these investment vehicles relative to kind of long-only equity and fixed income. And so the question is, why would you actually commit assets to this area? And there's only one reason, and that's because they offer higher returns at hopefully less risk. And so I've done a lot of work on the liquidity aspect of investing in alternatives. And for those of you who know me, know that I'm a big believer in getting paid for illiquidity. And there's a great chart in here in this this white paper, which shows the relationship between investment size, investment in alternatives of endowment funds, and returns. And it's pretty amazing because over a 20-year period, the largest funds have outperformed the smallest fund by roughly 250 basis points a year. So think about that, 250 basis points a year for 20 years. I mean, that is an amazing number. That compounds out to huge differential in returns. And so the question that I get asked and that I have to think about a lot is, why does this 250 basis points exist? And this chart in the white paper, as you'll see, relates it to the percent in alternatives. Obviously, the largest endowments have the heaviest allocation to alternatives. And I think there's some very interesting reasons for that. To me, the first is liquidity. And I've always been a great believer, as you think about long-term pools of assets, whether you're pension assets trying to grow at the rate of inflation to meet the obligations of the beneficiaries, or whether you're thinking about endowment, which is invested in perpetuity, the one advantage they have relative to many other institutional investors is their ability to invest for the long run. And so my argument has always been, well, if you're going to invest for the long run, you should really think about illiquid assets as an investment approach. And whether that's real estate or private equity, certain types of hedge funds, it's pretty compelling when you look at the numbers that illiquidity has paid off in the past. Now, there's lots of caveats around that. One caveat is you have to ensure that you have enough liquidity for crisis periods. And we've all gone through, 2008, 2009. We stress tested our portfolios in a real-time way, and it was stressful. So understanding how much liquidity you need, and it's outlined very well in the paper, in terms of how much daily liquidity you need, monthly liquidity, quarterly, and illiquid assets you can actually absorb in your portfolio, is a critical analysis that everybody has to do. And you really look at that during stressful periods. Now you turn that around and you say, there is a certain percentage of the assets that, based on your cash flows, your liabilities, your obligations, other things you need to fund, that you can actually invest in illiquid assets. And certainly based on history, not only does the percent in alternatives make a difference in terms of total return, but also the percent invested in illiquid assets creates higher rates of return. And that it's interesting because it's really irrespective of size. We've gone back and looked at these numbers and kind of sliced them and diced them a little bit more, looking even at size to say less liquid funds, even within a given size cohort, have tended to outperform pretty significantly more liquid funds, even within that size cohort. So, liquidity, I think, is a great thing to think about. The issue, of course, is making sure you understand how much illiquidity that you can afford to take in a fund. And I think what we've all read about the large endowments and the challenges they have with liquidity and being really forced to sell illiquid assets into difficult markets in 2008 and 2009, and even recently the announcement that Harvard's selling $1.5 billion worth of private equity. And really that relates to how much illiquidity can you absorb during stressful periods. The key is not to have too much, but enough that you can live through those stressful areas. As we get into things like hedge funds, obviously you have a different level of liquidity and risk, and I'm going to really leave it to my experts over here to the left to talk about those, but clearly understanding the return streams, understanding what the underlying manager is doing, ensuring that you're able to, in effect, get the returns that you want, that you know what is going to happen during a stressful period, or certainly during a significant drawdown in the markets. One of the things that you get, of course, when you think about hedge funds and liquidity associated with them is, in general, what happens is you take liquid assets. Most of them have liquid assets they're investing in long and short, and then convert them into illiquid assets by creating lockups or opportunities, only periodic opportunities to redeem. It actually is a pretty smart thing, because one of the issues that you have when you invest in any liquid asset class is you are subject to the challenges that other investors have in it. And we've all seen situations in which the investors who decide to stay may end up in a difficult position because you have significant redemptions coming in. And so it's understanding what the liquidity provisions is for yourself is really important, but understanding what the liquidity provisions are for others is also as important, because you can get really hurt if everybody else decides to redeem and you're left as the last investor or the last group of investors. Also understanding, and I think one of my colleagues just came out with a book on risk and hedge funds. One of his interesting points are twofold. One is understanding, and this is something that was very enlightening to me, understanding the financing of the underlying hedge fund is really important with respect to what the relationship is with the prime broker, because that's another issue of leverage and liquidity, where certainly during the crisis of 2008, 2009, a number of hedge funds had trouble maintaining their financings from the prime broker. And secondly, understanding the differences in motivation between the hedge fund manager and the investors. And it's really interesting from that perspective. Most hedge fund managers have a majority of their assets invested in their own hedge funds. That they may have a different risk and return perspective than going in a diversified pool of hedge funds. So I'm a big believer in understanding the complexity. I'm a big believer that you get paid for that complexity within reason. You have to understand, and I think as it pointed out very well in the paper, making sure you have the right resources to understand exactly the issues associated with that complexity are very important.
One question, if I could, Vern. I think it's been alleged, I can't remember the source of it, but that many times investors don't get enough value for the complexity, for the illiquidity they undertake. And I wonder if you could speak to that allegation.
Right, absolutely. I guess the question is, how much should you get paid for taking illiquidity risk? And I think if you look at it historically, say the difference between venture/private equity and public equity, the returns have been certainly historically 500 to 600 basis points if you're invested with the right managers with the right skill set. That's probably enough to take the illiquidity risk. If you don't need, on the other hand, liquidity, you might be willing to work for less than that, 300 to 400 basis points. We tend to think it's 450 to 500 basis points a year of excess return that you get from
Are you talking
taking
about
it in.
hedge funds, or are you talking about private equity?
I'm talking about private equity relative
Okay.
to public equity.
Yeah. How about hedge funds? Because you get a degree of illiquidity there as well.
Yeah, I think the illiquidity there is for different reasons generally, and clearly one of the issues with hedge funds is that they're taking liquid assets and converting them into less liquid instruments, right? And so some of that really is to protect all investors and the hedge fund against what I would call irrational behavior, which tends to happen. I don't know about all of you in this room, but we have seen investors panic at times, and so that panic prevention mechanism, I think, actually is a good thing, and probably adds to long-term returns relative to if you didn't have it. So but it's clearly not the 500 to 600 basis points that you'd get in the relative to the private versus public markets.
Thank you. Gordon Yeager, would you like to hold forth?
Sure. Thanks, Rusty. Certainly happy to be here tonight, and certainly enjoyed working on the best practices document. I wanted to try to touch on each of these topics, as many points as I can before Rusty cuts me off. From the perspective of a risk manager, and from the perspective of as an investor in hedge funds, the kinds of things that you should be thinking about or asking when it comes to these very complex topics. The first is probably my least favorite, which is liquidity. It's my least favorite because it's by far the least quantitative, at least to me, of these measures. It's not that bad if you're an equity manager. Certainly, the day's average trading volume is a pretty good idea of how liquid something's going to be. Perhaps more importantly is to really understand the largest holders list. Not only how much they own, but who they are. If the top three are private equity funds, your liquidity is a lot different than if it was otherwise. One complication from an equity liquidity standpoint that we've seen, particularly this summer, is the rise in trading of ETFs. The prime brokers reported that up to a third of the daily volume was at ETFs. Almost all of those late day rallies were in ETFs, and the returns that you can expect from a non-S&P equity are much different than you saw in the S&P itself, and the implications for liquidity are a whole lot different. When you're speaking with managers, this is a pretty important topic to speak about, particularly as it pertains to their shorting. It's quite a different world than it was 4 or 5 months ago. On the fixed income side, we're not quite so lucky with the amount of data we can use to quantitatively measure liquidity. The trace volume data is sketchy at best. It's pretty weak on the high yield side. Knowing how much of an issue a manager holds is important, but way more important is who holds the rest of it. Difficult to come by unless you're really involved in the market, and then it's still pretty difficult. So there's a number of factors that are not so straightforward that you can talk kind of conversationally with your manager about what they may be looking at. As a manager of high yield and distressed assets, one of the things we're tracking is what lot size something trades in. We're also tracking how many dealers are actually making a market in it. And I call this the kind of number of phone call measure. How many calls is it going to take me in a normal market to sell this position? Now, the key phrase is normal market. We don't really have any models to model what happened in 2008 when markets just completely dried up. Which leads me to your favorite question to ask me when you come into our offices, and I think it may actually be required by law or something, which is how much can you sell in a day, a week, a quarter? It's such a difficult question. I mean, there's really no way. There's such a range of answers you can give depending on what the environment is, and you can expect to get a range of answers. From the exact same portfolio, from a meeting, at 400 Park Avenue to 410 to 430, I mean, you can get dramatically different answers, and you have to kind of take those for how dramatically different they could be. I don't think you ever glean a whole lot of information from that, but hopefully some kind of qualitative discussion about the assets comes from that where you can get a better idea of liquidity. The more important questions, which Vern touched on, is the other side of liquidity, the liquidity that the hedge fund's responsible to meet. How much redemptions can they get at any one point? And getting a bunch of redemptions at one time is the most difficult aspect for a hedge fund. And the best risk mitigation tool that I've found for that is something that investors don't usually like, but the investor level gate, preventing everyone from coming to the door at the same time, giving everybody the same liquidity terms, but limiting it to something like 25%, is at least as much protection for the investor as it is for the fund. Moving on to leverage, where I spent some time on the paper. This one is complex, but for an educated investor, I don't think it's quite as complex. Really three main points that I think you have to focus on. The first is to really understand the strategy employed. Leverage in and of itself isn't bad. Used the wrong way in a strategy that doesn't require it is bad. So you really need to understand how the strategy works, what leverage makes sense, what doesn't, and measure it on those relative bases. The best practices document actually does, I think, a pretty good job of outlining some of those and the differences between the strategies. The second would be to understand how leverage is measured. Now, this one can get a bit complicated because I can't count the number of ways that you can measure leverage. I think the white paper does a very good job on this. The key takeaway from that should be that one measure isn't enough. One fund or one strategy may measure leverage one way, and if you're an arbitrage fund versus long-short equity, you're going to talk about your leverage in much different terms. But you should go beyond just the leverage number that they're providing in their monthly to really get a handle on what's going on, whether it's notional value or market value or long versus short and gross. You need more than one of those to truly understand the leverage being deployed. The third, and in my mind by far the most important factor to understand, is the cash on hand. Beyond increasing risk, leverage increases your potential to have to make margin calls. And every hedge fund blow-up I know of that wasn't because of fraud was because someone couldn't make a margin call. It's a little tough sometimes to know, though, how much cash is needed. And again, you're going to need qualitative discussions because sometimes it's not intuitive. If you have a hedge fund that is 200% long, no shorts, versus a fund that's 200% long and 100% short, that second fund has less risk, but it potentially has a greater risk of margin call because the bases between what they're long and short could have margin calls on both sides. And I would argue the shorter we get sometimes, the more cash I want on the sidelines. So it's really important that you just don't think of leverage as increased risk, but increased risk of margin call, and you've got to tie that into cash. It's all about cash management. Volatility. This is the main tool in the risk manager's toolkit. It's the basis of almost everything we do. It really drives risk measures, but it's not always clear sometimes which volatility you should be using. As a case in point, let's consider a high-yield bond that's been trading at par for quite some time, and all of a sudden gaps down to 80. The reality is that this bond is now more like an equity with a big dividend than it's like a bond. And using a duration-based measure may not make as much sense as moving to more of a beta-type approach. What we've done internally is built models where we're using a number of different factors and modeling stress and distressed bonds much differently than just taking simple fixed income measures. We're still using volatility as a basis for much of this, but it's a different vol, and it's one that's more appropriate for that asset. Another interesting case study is Lyondell, which came out of bankruptcy about a year and a half ago now. When Lyondell came out of bankruptcy, they had a very interesting rights offering associated with their emergence, where if you went to bed one night with $100 of a loan, you woke up the next morning with $150 of an equity. I think a lot of risk managers woke up that morning and pressed their bell and rang it and ordered, we have to get rid of this huge risk that just appeared out of nowhere. The fact is, this risk was known about way before that day. Weeks and weeks before, you knew exactly how much equity you were getting for that loan. You knew exactly what the rights offering was. And the way we modeled it internally was, instead of modeling this as a loan, once it's known for sure what equity you're getting and what the rights offering is, we modeled it actually as an equity. It's actually equity risk at that point. So if we had 100, let's assume that when it came out, we thought it would have a beta to the equity markets of 1, just for simplicity's sake. So one day we own $100 worth of a loan that I'm modeling with a 1.5 beta to the equity markets. When it emerges, that day I have $100 of loan that I'm now modeling with 1.0 beta to the equity markets. So there wasn't any big change in risk for us. We knew how the positions should be sized before that. It wasn't a surprise. And that's really one of the kind of key aspects that I think people should be looking for with the risk management function. It's not just limits and a policing function. That can lead to a pretty adversarial relationship sometimes that gets a little unhealthy between a risk manager and a portfolio manager. There's a lot more that risk management can offer to the investment process. And I think by partnering with them and kind of, for you, exploring how that relationship actually works, it becomes a much, much healthier relationship. I mentioned beta. It's hard to talk about volatility without talking about correlation. You put the two together, you get beta, so it's probably worth talking about. Without getting too technical, beta is the covariance of a stock versus an index over its variance. Just think of it as correlation over volatility is an easy way to think about it. And many stocks exhibit low betas, not because they're low volatility, but because they have low correlation. So if you're doing an analysis on how much this fund could be up or down based on beta, works fine in a normal market. When the market performs like it did this summer, when it gaps down 10% and all correlations go to 1, that numerator on top of that beta calculation is getting higher too, and you can expect the moves in those kind of securities to be dramatically higher. So it's important that risk managers are looking at modeling correlations as well as just moves.
Don't shoot the messenger.
Hey. There you go, Rusty. I got called out. I'm done.
You wrapped it up. Well, one question for you. You mentioned that the gate of, say, 25% is a protection for investors as well as for the fund itself. But if 25% of the fund suddenly wants to come out, what does that leave for the remaining 75% in terms of liquidity?
Yeah, well, that's, when if you don't have investor level gates and you just have fund gates and 1/4 of everyone decides to come out, it's pretty penalizing for that other 75%. Which is kind of the benefit of the investor level gate, so that the other 75% of the investors aren't held captive by the 1/4 that wants to come out. Everybody's gone into it knowing I can get all my money out in a year. It's just going to take me 4 quarters to get it out. And you don't have, the only way you have this 25% is if everyone's coming in at once. And in that case, someone throws up their fund gate anyway. So I think that this type of level gate avoids exactly that kind of problem where the others are held captive by, you never really know what the motivation of your fellow investors is.
Are there many funds that have investor level gates now?
I think it's more common. I think it's more common in less liquid assets. I think it's a better way than saying you're locked up for 2 years. It's a better way than having to suspend and creating some kind of SPV. And I think everyone has a certainty. And certainly, when you ask the question and ask how much of your assets can you sell in a quarter, and you say 50%, well, if only 25% can come out, you've got a lot more comfort level that you're not going to be in the situation that many were in at the end of 2008.
Thank you. John, would you like to
Absolutely, Rusty. And I'd like to echo Gordon's thanks for the both to the Roundtable for its production of some very valuable intellectual property for the industry and the opportunity to speak tonight. I'm going to take it down to a much lower level of detail, and for those of you who know me, that's where I spend most of my time, in the pipes and the sewers as a chief operating officer and a risk manager. But I'd first like to start with a macro assertion, and that is that the importance of this paper, in particular on complexity, is only going to grow as the global delevering continues its inevitable course. And by that I mean just the volatility that we're about to experience is going to test a lot of the pipes and sewers, a lot of the contracts and instruments that are taken for granted as inviolate under conditions that we've not seen before. And the basis of that is that we're really in the midst of a decline from the golden age of financial engineering, which was facilitated by securitization, globalization, derivatization, if that's a word, deregulation, and an overly accommodative monetary policy. And the following consequences, no doubt, were intoxicating. We experienced a steady decline in the cost of capital over the past 30 years, a higher degree of precision in identifying and managing risks, or at least the perception that we had a higher degree or an ability to manage risk with a higher degree of precision. The development of increasingly broad and deep repo markets, and as a consequence, a higher level of comfort with leverage. In short, I think we felt heading into 07 and perhaps even heading into 08 that we had it wired, that we had it figured out. But the failures of Bear Stearns and Lehman were reminders that, as in most cases, markets tend to take things beyond their sustainable levels, and unmercifully, that 30-year growth in leverage started its decline. For the past 3 years, the public sector has really taken up the slack as the private sector has delevered. But obviously what we're witnessing now is that markets are telling sovereigns that they can no longer continue to grow their debt at a rate that exceeds the growth in their economies. So I'm sure there are many views on what will ultimately happen in Europe, but it seems as though the foundation is set for some pretty extreme volatility over the next year, and so that's, I believe, the basis on which a lot of the techniques, if properly applied in here, will aid an allocator in determining where weaknesses may exist. One of the things that we know, and we've talked a little bit about leverage, is that much of it today is taken derivatively, which complicates the ability to assess risk because of the opacity and the inability of our accounting processes and guidelines in identifying risk. And also, it introduces complexity from a legal and operational standpoint. This is probably, there's probably no better time than right now to fully understand exactly, certainly if you're a hedge fund manager and if you're an investor in a hedge fund, what your hedge fund manager does in terms of managing its cash and its collateral. And there's no better lesson for that than what happened to funds that use Lehman Brothers as a prime broker. So what I'd like to do is focus on really 5 areas, and as I said, I'm going to take you down into the pipes and sewers, and I apologize, but I do think that these are things that often get overlooked, and so by just as someone who has an inside perspective, I thought it might be helpful to highlight some of the things that you may want to ask your managers. First of all, with respect to cash, with the spread between short bills and the 2-year note at 20 basis points, why would anyone want to take duration risk? Is 20 basis points or is, if you go a little bit further out the curve, is even 50 basis points going to move the needle? And what are the consequences if all of a sudden the monetary policy that's being currently undertaken does grip and take hold? So, cash should be managed with minimal duration risk. Similarly, with credit risk, the risk reward is just not there. Take, for example, investing in a 90-day piece of paper for 100 basis points of yield enhancement. That's 25 basis points annualized. That's the upside. The downside is that there could be a credit event and you could find yourself owning a piece of paper at workout prices, 30 cents on the dollar. So your reward is 25 basis points. Your risk or downside, let's call that 25 cents, your downside is $70. So if you think of that on an expected value basis, it would take you 70 years to roll that successfully to be adequately compensated for that 100 basis points of extra yield you're trying to achieve by reaching. So, your fund managers probably are there to derive alpha from some or other element of the marketplace and not from managing their cash. Probably the best place to have the cash is in short duration, low risk instruments. And as importantly, they should have those assets custody at an institution that creates some diversification in terms of counterparty risk that they have. Many simply will custody their bills or their cash equivalents at their prime broker, but they already have extensive exposure there by virtue of the financing and the clearance that they're conducting through their prime broker. So why concentrate your exposure by leaving your cash equivalents there? Probably better served to take those cash equivalents and leave them with another institution that has less exposure to the capital markets. State Street, Harris, Brown Brothers, or if you want to add some country diversification, some of the Canadian banks would be an excellent custodian for your bills for liquidity purposes. So it's not only the instrument itself, but it's where it's kept, which is important in protecting your cash or cash equivalents. Turning secondly to prime brokers, just a few questions to consider. How are fully paid for securities held? Again, this is similar to the cash equivalent question. If you fully paid for an equity security, do you really want to leave it with your prime broker where you again have exposure with the financing transactions and the clearing transactions that you're doing? Or why not take advantage of the opportunity of putting it with one of those other custodians, diversifying your exposure and removing it from the risk that many of the capital markets intensive prime brokers carry. Secondly, and this gets down to really, and I apologize, it's getting really down to the nitty gritty, but it's not a question that many folks focus on, but it is really a source of a lot of exposure, particularly in your long short managers. How does your short manager collateralize, your long short manager collateralize the equity bar that's undertaken to cover a short? Most collateralize it with an equity long. But if you do that under Reg T, you have to pledge 2 times the market value. So you're putting up $100 million worth of securities to collateralize the $50 million borrowing. And again, if something happens to your prime broker, that's $50 million of clean exposure. So you're probably better served to take the cash instruments that you're holding. If you're holding bills, and under Reg T, you can pledge dollar for dollar. So pledge $50 million worth of bills against your $50 million borrow, and take that $100 million of equity, of long equities, and pledge those, give those to your custodian. They'll hold them separately. And that's a way to significantly reduce your credit exposure. And then lastly, this is an area that is not often addressed, is what are the contingencies embedded in the prime brokerage agreements? Are there AUM thresholds or NAV thresholds that allow the prime broker to terminate the relationship or to accelerate a financing? And if so, are those thresholds sufficiently remote? So, that is a question you should ask, and you should satisfy yourself that if it's a NAV down 25%, is that sufficiently remote given the strategy that's being undertaken. Thirdly, shifting to OTC derivatives. Derivatives, again, another nuance. The convention for collateralizing OTC derivatives is to post initial margin and variation margin. The initial margin varies depending upon the volatility of the underlying contract. And it is, when posted to your counterparty, it can be used by that counterparty for any purpose. It could be used to fund their general corporate activities, unless your LP uses tri-party. So it's a mechanism whereby collateral can be posted with a third party and can only be accessed in the event that the underlying contract requires a margin call. And it keeps that collateral from being commingled in the event of default by the prime broker. Fourth area, repo financing. Both Fern and Gordon touched on that. I think it's very important to ensure that the term of the repo financing that's being relied upon by the LP that's using leverage be significantly long enough to ensure that if there was a temporary loss in liquidity in the marketplace, that there would be an adequate window to liquidate those assets. So that is critically important. And as Gordon said, if not fraud, that's probably been the source, not being able to meet a margin call. And then also with respect to repo agreements, are there contingencies similar to the ones mentioned in the prime brokerage agreement? Can the repo be accelerated if there's a decline in AUM or a decline below a threshold in NAV? And lastly, just a thought, CDS is starting to get a lot of attention given what's going on with sovereign debt in Europe. Just to highlight one potential area of significant exposure, and that is the use of CDS to hedge a long position in sovereign debt. It should be explored whether or not that CDS will experience similar economic characteristics in the event of extreme volatility. It's hard to know. Will CDS be honored fully or in part? And the only way to know that is to ask your managers to stress test their exposures, not netting before they stress, not netting the long CDS against the underlying sovereign bond position, but stressing the two independently so that you can see exposures. And then if you want to aggregate, you can, but then you can understand what the contractual gap, and I think this is something that we'll probably learn to focus on. What is the contractual gap that exists in a book? I think it's taken for granted now that these contracts are inviolate, that if you've got a CDS hedging along, that the two will move in parallel. What happens if they don't? They're not the same instruments. You cannot pair them off. So just something to keep an eye on. So as I said at the beginning, I think the importance of understanding the nuances of these contracts as markets are becoming increasingly dependent upon derivatives and contracts to take exposures is going to be an area that requires a lot of attention and really have to get down and understand with precision how these risks should be taken to understand that contractual risk.
John, looking at it from the standpoint of an investor who's got a portfolio of 8, 10, whatever number of hedge funds, how does he satisfy himself on all 5 of those points?
Well, this is, I think post-Lehman, there's been a lot more, when I was at Tudor, I noticed increasing attention to a lot of these points. The operational due diligence was getting a lot more attention, whereas previously it was, predominantly focused on the investment process. But today folks are doing it. It may require someone with expertise in these areas, in understanding contractual law. How are ISDAs written? How are the repo agreements written? How do prime brokerage agreements work? And understanding, how effective their managers have been at negotiating the terms. These terms are not, the term from one LP to another, one one client of a prime broker to another are not the same.
As an investor, I should read the agreements for prime
I don't
broker.
think, Russ, you necessarily need to get to that level, but I think if you ask questions that probe about some of the, the weak areas that may exist, you should be able to flush out the extent to which the managers thought about these issues. If they fumble and, don't know, they probably haven't thought much about them, and that's could be a yellow flag.
That's very
if
helpful.
Not a red flag.
That's very helpful, John. Thank you.
Welcome.
I would like to cover some of the highlights that are in this white paper, but first I would like to say that this is a work of multiple people who put a lot of time in it, and Steve is going to recognize some of those shortly. But I'd like to recognize one person whose this paper would not exist without his vision for it, and without his providing the glue that has kept the team together making this paper, and that's Steve, who doesn't even have a name tag.
We all know. Thank you. Thank you.
As soon as an investor gets into alternative investments, he's taking on a great deal more complexity. Our speakers have talked about some of it, but some of it is just in the record keeping and setting up the asset allocation. Many people like to use an efficient frontier method, and that's fine if you can deal with all the complexity in that. With the traditional investments, you can get a policy portfolio that makes a pretty good benchmark for traditional investments. What do you do for hedge funds and private equity? What kind of a benchmark can you use for hedge funds? There's multiple indexes of what different kinds of hedge funds have done, and they're different, and they're all based on what hedge funds have done, not what the opportunities might be, as is the case with index funds. I think you've got to separate, the investor has to separate its valuation. Set up an evaluation system based on a policy portfolio for your traditional assets, and then set up a separate evaluation for hedge funds, which may mean you have to use some special valuations for different kinds of hedge funds. And for private equity, where you don't know how well somebody's done until years and years go by, that's a whole nother thing. And how you go about making your asset allocation is a further problem, especially with private equity. Say I want to get 10% in private equity, and I've got to allocate more than that, or I'll never get up to 10% because people are paying back while we're paying in. The complexity that is just in the operation before you get into these other problems of volatility, leverage, and liquidity, which together make for a potential explosion if it gets out of hand. Well, let's talk about them. Volatility, which is kind of the beginning of complexity, and it affects all kinds of assets, traditional and others. And the volatility starts with the valuations. Now, if accounting fraternity has helped us. They've come up with 3 levels that and tell people just how to do it. And we now have much more precise valuations of our hedge funds and especially of our private equity. I'm not sure too many people feel it's more accurate, but it's been a wonderful thing for the auditors because they have to spend more time on it, which we as investors wind up paying for. Another aspect of volatility is how do you measure it? The traditional way of measuring, talking about volatility, it needs to have prefaced by the fact that that's not a measure of risk. It's one of the measures of risk, and a very important one, but that's the first thing people talk about. And they usually talk about standard deviation or Sharpe ratios, which are based on standard deviation, and standard deviations have three serious caveats that we need to understand. The first is the standard deviation is built on a normal curve. Well, what happened to a normal curve in 2008? These left tails, we have to do something to adjust our normal curve to account for that. More on that later. Another basic underlying assumption is that one accounting period, the return in one accounting period has nothing to do with the next accounting period. And that isn't quite so, because the monthly or quarterly returns may be compounding, or they may even be reverting to the mean. If they're compounding, the standard deviation understates what the real volatility is. And if they're reverting to a mean, it way overstates it. So I think there are two ways we need to measure standard deviation. In a hedge fund, if you're doing it, taking monthly returns, typically we use annualized monthly returns. But that doesn't provide for what's happening in terms of the compounding and the mean reverting. I like to run two measures. One is the annualized monthly returns, and the other is a rolling 12-month. That picks up a good deal of that. It has a problem because you progressively underweight the first 12 months and the last 12 months in any interval, so you want to use it for a long interval. But if you use both of them, you then get an idea of how the compounding and mean reverting is working. The third caveat is if I take a standard deviation for interval, how representative is that standard deviation for that manager? And probably not all that, because if you look at standard deviations over different intervals, long intervals, you get different results. And so I think you still got to use standard deviations and Sharpe ratios and such, but use them with some qualitative evaluation. Most people, when it comes to hedge funds, like to measure volatility with drawdowns, and that makes a lot of sense, of course. Related to this is the subject of correlations. And correlations are the basis for what is referred to the free lunch in investing. Having a low correlation with what? What is the greatest risk all of us have in the investment portfolios we own as investors? It's equity risk, the risk of the stock market. So it's very important as we evaluate hedge funds to try to measure their correlation against the stock market. A hedge fund with a 0.7 valuation might be very valuable to us, but it doesn't provide that much diversification benefit. If we can find hedge funds that have 0.3 and lower correlations, that they can add a good deal more diversification benefit to our portfolio. They're just harder to find. The same caveats for standard deviation apply to the correlations. You want to run them on comparing annualized monthly and also rolling 12 months or something measures of that nature. But one thing we have to expect is that they're going to converge toward one in times of market crisis. And if we don't expect that, we're being unrealistic. And that means we have to expect volatility in our portfolio. We have to manage for it. And if we can't expect it, we are not being realistic. So the thing is, how can we manage the volatility, especially these left tails? I think it can be helpful. Some folks have felt it helpful if you do your rebalancing of your portfolio based on the riskiness of assets, not just on the name of the asset class. That can help somewhat. But how do you deal with the left tail risk? Well, if occasionally you can find a cheap option, that can be helpful but you don't find that many options that are that cheap. You can hedge for a big portfolio drop like 2008, but if you do that on an ongoing basis, you're going to be behind the eight ball. You'll lose more money for the hedging than you. At any rate, going into leverage, we've covered a great deal about leverage so far, and liquidity. Leverage, of course, is not a proxy for risk. It can be increased risk or it can lower risk. It depends how it's done. And we've talked about the difficulties in measuring that, which is critically important. And evaluating it, not just the quantity of the risk, but as my friends have been saying, the quality of that risk. Is leverage going to be there when you need it, and how liquid is it? On liquidity, from the standpoint of the investment fund, we need to have an ongoing evaluation of our own liquidity. How much money can we raise in a day, a week, a month, 6 months, or a year? And we should have guidelines on that. And they may vary depending on how our investments are at times. And we should be then looking at our investments and saying, how do we line up with the target liquidity that we want in our portfolio? And then make a second column. How liquid are we in the event of another 2008? Because we've got to be prepared for the worst when the worst happens. The problem, of course, is you don't want any more liquidity than you have to have because you pay for it in opportunity cost. I won't repeat what Vern so cogently passed on to you. Vern and John Griswold were very helpful in providing the Kubo results, which Vern referred to, showing so clearly how the more competent and larger the organization is, and the more they've been able to use alternative investments, it's really paid off for them in the last 10, 20 years. But that doesn't answer the question for me and my particular fund. Has it been worth it to incur all the complexity? And every fund has to answer that for itself. You might say, how would I have done if I invested in the old-fashioned 60% S&P 500 and 40% Lehman Ag? But have the problems that we've incurred, have I gotten paid for it? And maybe if I have just gotten into alternative assets because they've been doing it here and they've made some money on it, that may be the wrong reason for me going into it because I'm not prepared to do it competently. So the question I have to ask myself is, can I get the staff? Can I get adequate consultants to give me the competence to invest effectively in alternative assets? And each of us has to answer that for ourselves. Thank you very much.
Thank you, Rusty. This isn't the sexiest topic we'll ever hear about, but it is at the core of the principles of investing. And, this is the best part of my job. I'm really blessed to be with people who are doing this in an altruistic sense. And as Rusty said, this isn't one person spouting their opinion, but we really are an interdisciplinary group going across all lines of limited partner. And I want to honor our chairman for herding all the cats together. So we've Ed Barksdale, this is your fourth. Mark, this is your third. And fellows, would you like to say anything about this whole process? Has it been worthwhile to you?
I would say it's been a wonderful experience. It's been great to have Mark as a co-chair and the other members of the team, no question about that. I do think that what we're doing is, to a certain extent, a product of the times. And I think it's important to put the focus on alternatives and the contribution that alternatives have made into the context of what I believe is a consolidation period following one of the great bull markets of our time. And it's very important to assess where this fits over this period compared to where it would have fitted in the 82 to 2000 period, and where it will once again fit in the environment of a bull market, assuming we will in fact live to see another one. During this period of consolidation, I think that these are extraordinarily important things. There may not be anything in this book that makes you any money, but what I hope is that there are a lot of things in the book that will cause you from making bad mistakes and losing money. And this is an environment where it's in some ways more important not to lose big than it is to win big. And I think that that's the primary focus of this book, is to make sure that we examine the issues and the questions and avoid the mistakes that with 20/20 hindsight will look like stupid mistakes, but seem like a good thing at the time. And I think that's the real focus of this publication.
Yeah, I would. It's hard to add to what you said. But it's been a great experience working with so many people who contributed a lot to it, both from within the Roundtable group and all the different investment professionals that we talked to, and got their insights and have been able to share in the piece. So, like you said, Ed, I think it hopefully doesn't necessarily help someone make money, but will have some positive influence in the way people put their portfolios together and making sure they're prepared to do the things that they do to make more money and to protect them from losing money in these very treacherous times.
Thank you, Mark. And this is one of the most gratifying parts of my job, which is embarrassing you. So for the next, so the following people stand up: Rusty Olson, Vern Sidlacek, Ray Gustin, Mark Silverstein, Ed Barksdale, Gordon Yeager, John Griswold, John McFarland, and Bob Stone.